A major concern for those who follow the Chinese economy is the country's debt. Descriptions range from a debt problem all the way to a debt bomb. Pessimists say debt here in China has grown too much, too fast, and it's too hidden. So, will there be a debt crisis here in China? I believe no. Here's why. Number one, almost all Chinese debt is denominated in its own currency. At the end of 2018, foreign currency loans took up only a tiny sliver, 1.55% of all bank loans. That means Chinese debt can be fully managed by the country's financial regulators. It's not subject to external pressure of credit drying up from abroad. Number two, many are sounding alarm on the rise of Chinese corporate debt. However, we have to remember that state-owned enterprises take up over 2/3 of all corporate debt. SOE corporate and government debt together form nearly 60% of total Chinese debt. Again, that means policymakers have flexibility in managing credit, as the government holds ample, high-quality assets that easily covers all government and SOE corporate debts by a multiple. Number three, shadow banking credit has significantly decreased from tighter regulation. For example, three major categories of once popular shadow banking credit, entrusted loans, trust loans, as well as bankers' acceptance bills, plummeted some 11% on aggregate by the end of 2018 from its peak at the end of 2017. This means that credit channels are more transparent, systemic risk and complexity is reduced, and loopholes are being closed. Number four, the composition of those receiving credit is changing in a positive way, making the system safer, sounder, and more efficient. Now, since the beginning of 2015 to the beginning of 2019, the pace of credit to the much less indebted household sector is higher versus the leveraged corporate sector. Loans to households jumped by 7.3 percentage points during this time, while loans to corporates and the government fell by 7.5 percentage points. Now, this rebalancing means that as parts of China deleverage, other economic agents are picking up steam. Number five, there is colossal potential in boosting equity financing here in China. Currently, only 3.4% of all financing for non-financial corporates is raised via equities. China is firmly on the path of capital market reforms, and the healthy development of a mature and vibrant stock market is certainly on the agenda. That signals we will eventually see companies less and less dependent on debt to meet their fundraising needs and rely more and more on equity. Now, China's debt levels are indeed high, and they have grown quickly in the past few years. But despite that, China will not experience a debt crisis. It's not enough to simply look at a headline debt-to-GDP ratio. Now, there will certainly be bumps along the way as restructuring and reforms continue. But policymakers have recognized, have the tools, have the experience, and have implemented corrective steps in dealing with the country's debt challenge.